Hey everyone, and welcome. So let me ask you a question. Do your trading charts look like a complete mess of lines and indicators? And do you feel like you're always just one step behind the market's next big move? Well, in this explainer, we're going to cut through all that noise. We're going to reveal a really simple but powerful strategy that's based on the only two things that actually move the market. Ready? Let's dive in.
Yeah, I'm willing to bet this screen looks pretty familiar to a lot of you out there. I call it indicator overload. You've got so many signals flashing, so many lines crossing, that you can't even see the price anymore. Honestly, it's just a recipe for confusion, hesitation, and you guessed it, losing trades.
You know, the common wisdom is to add more stuff, right? Add another indicator to get a clearer picture. But what if I told you that's exactly the wrong way to go about it? The real secret to consistently profitable trading isn't adding more complexity, it's stripping it away. Today, we're going to completely declutter your charts and your mind by focusing on the two absolute fundamental drivers of price.
And this brings us to a really crucial idea, what I call the myth of complexity. We're kind of conditioned to believe that more information leads to better decisions. But in the fast-paced world of trading, it's actually the opposite. Too much data just creates analysis paralysis, that feeling where you're so overwhelmed you just freeze up and can't make a decision at all.
So what happens when we strip away all that noise? I mean, all of it. What are we actually left with? Well, it turns out the market is surprisingly simple. It's driven by just two core forces, and if you can master these two, you will have an edge that frankly most traders will never find.
And here they are, the two pillars of this entire strategy: market structure and liquidity. That's it. Seriously, no complicated indicators, no secret formulas. Just a deep, solid understanding of these two concepts is going to completely transform the way you look at a chart.
Think of it this way, okay? Market structure is your compass. It tells you the direction. Are we heading north, south, or just wandering sideways? And liquidity, that's your fuel tank. It tells you where the market's going to find the energy for its next big push. You absolutely need both to get where you're going.
All right, so let's dig into that first pillar. Before you even think about placing a trade, your number one job always is to just read the market structure. You have to understand its current direction.
It all starts with this simple truth. The market can only be doing one of three things. It's either going up, it's going down, or it's going sideways. That's it. Your job is to figure out which one it is and then play by its rules. And this is non-negotiable. Don't fight the trend. And seriously, stay out of those choppy, sideways markets.
But how do we know if a trend is real? How can we confirm it's actually happening right now? Well, we use this incredibly powerful concept called a break of structure, or BOS for short. This is our green light. It's the market's way of telling us, hey, this trend is strong and it's probably going to continue.
Let's break it down. As you can see here, an uptrend is just a series of higher highs and higher lows. And a downtrend? The opposite, lower lows and lower highs. Simple, right? A break of structure happens when price smashes through a previous high in that uptrend or a previous low in a downtrend. This is what confirms the trend for us and gives us the confidence to look for a trade in that direction.
Okay, so we've got our compass. We know which way the market is heading. Now we need to find the fuel. We need to go looking for that liquidity that's going to power the next big price swing.
This is such a powerful way to think about it. Imagine liquidity as these big pools of money, just sitting there, waiting to be filled. The market, especially the big institutional players, acts like a magnet. It's constantly being drawn towards these pools. It's not moving randomly. It's moving with a very specific purpose.
So the big question is, where are these pools of money? Where's this fuel hiding? Well, it's actually pretty simple, and it's hiding in plain sight. They're located exactly where most retail traders put their stop-loss orders. Think about it. Above every major high, there's a pool of buy stops, and below every major low, a pool of sell stops. These are the magnets the market is always targeting.
Okay, that makes sense. But how does the market actually use this liquidity? How does it take advantage of all those orders sitting there? This is where the strategy really comes to life.
It's a classic three-step move that institutional traders use all the time. It's called a liquidity grab. Here's how it works. First, liquidity builds up as traders place stops in an obvious spot. Second, the market makes a sudden, sharp, fake-out move to trigger all of those stops. And third, and this is the important part, now that it has the fuel it needs, it reverses hard and takes off in the opposite direction. Our entire job is to catch that third move.
Okay, so we've covered the two pillars, structure and liquidity.
Now, let's put it all together. Let's combine them into a clear 4-step action plan that you can actually start using. So here it is, the entire game plan on one screen. It's so simple. Step 1, identify the structure. Step 2, locate the liquidity pool. Step 3, wait for the liquidity grab. And step 4, enter on confirmation. That's the whole process. Now, let's see how it actually plays out on a chart.
Let's look at a classic setup for a buy. First, step 1, we have a clear uptrend. The market is making higher highs, higher lows. Our bias is definitely to the upside. Then, for step 2, we see the market create these equal lows right here. To a trained eye, this is a huge red flag. It's a sign that a giant pool of sell-stop liquidity is building up right below them.
And then, bam, step 3. The market makes a sharp move down, takes out all those stops, grabbing the liquidity, and then reverses on a dime. That's our signal that the real move is about to begin. So for step 4, we don't chase it. We patiently wait for price to come back to this demand zone, the spot where that big move started, and we enter there, ready to ride the wave up with the main trend.
And the best part is, this isn't just for buying. The exact same logic works perfectly in reverse. In a downtrend, you're looking for the market to spike up, take out the highs, grab that buy-side liquidity, and then reverse downwards. The logic is identical, just flipped upside down. It's actually beautifully symmetrical.
And I want to be clear, this isn't some rare once-a-month setup. This pattern happens every single day on every single market on all different time frames. Once you train your eyes to see this two-part process, structure first, then liquidity, you'll start seeing these high-probability opportunities absolutely everywhere. And this all leads to a really crucial mindset shift. You have to stop trying to predict the future. You're not a fortune teller, you're a detective. Your only job is to gather the clues the market is giving you, wait for it to show its hand, and then act on that information with precision. You want to be a reactor, not a predictor. And that really is the bottom line, the key takeaway from all of this. Stop predicting, start reacting. Read the structure, follow the liquidity. Let's say that again because it's important. Read the structure, follow the liquidity. That is your new trading mantra.
You know, we've really only scratched the surface today. If you want to dive deeper into this strategy and learn some of the more advanced concepts, it is packed with even more examples and details. Thanks so much for joining me today, and I'll see you in the next explainer.